Have you ever wondered what is the best investment? So many people debate the benefits of stocks, real estate, or private equity. The truth is, it doesn't matter. You're asking the wrong question. Each of these has made millionaires. These are all good investments for the right person at the right time. The key is not finding a better investment, but rather becoming a better investor. So what makes a good investor? Well, today I'm going to share the 6 biggest things that completely changed how I think about investing and ultimately helped me to succeed in my own journey. At first, I honestly wanted nothing to do with it. I was busy working long hours, and the last thing I wanted was to spend my precious time learning about finance. The turning point for me came when I looked at my retirement accounts and saw that my return was barely 2%. That was my wake-up call. I had to stop thinking of myself as a doctor who couldn't understand investing and start thinking from an empowered framework, which is why your mindset is so important. These financial gurus were just like me, but they had studied finance instead of medicine. Certainly, if I could get through medical school, I could learn what I needed to for myself. Honestly, it was easier than I expected. First, I started with books like Think and Grow Rich and Rich Dad, Poor Dad. These were great in helping shift my mindset from earning a paycheck to generating income through assets. I learned how passive real estate syndications work and how the tax code incentivizes investors and business owners. I used to think that wanting to make money was somehow a bad thing, but I realized it's not only normal, it's vital to the growth and development of our society. You see, money is the exchange of value. People only pay you if you provide them something of value. That means those who are seeking to create a business or wanting to make money are really trying to create value for others. Once I shifted my mindset, I committed to learning. I started reading even more books, taking courses and mentorships, and listening to podcasts every chance I could get. I finally understood how things like volatility and fees affect returns. For instance, if you purchase a stock for $100 and it increases 30%, it's worth $130. If it drops by 30%, it's now worth $91. The average return is 0. However, the actual return is minus 9%. It sounds like a magic trick, but that's the math. And I knew I was paying fees, but I didn't realize how big an impact this could have over time. For instance, with no fees, $100,000 grows to about $1 million over 30 years at 8% annual return. With a 1% annual fee, it grows to a little over $760,000 at a net 7% return. That's the difference of over $245,000 or 24% less money in your pocket. Beyond that, we have to consider inflation and taxes. If inflation is at 3% and your return is at 6%, your real return is only 3%. All these things have a significant impact on the bottom line, and these effects are exaggerated over time due to the effects of compounding. And if we don't understand these things, we don't know how to account for them and how to adjust our strategy. That's why it's so important to network and talk to people outside of your professional and social circles. At first, I only talked about money with my close friends who were mostly other doctors. So guess what? We were all saying the same things, complaining about taxes, working more shifts, and saving in our 401ks, and hoping it would be enough. Then I went to my first real estate meetup. I was nervous, but it was one of the best decisions I've ever made. I met people who were building businesses, buying apartments, and creating passive income streams I didn't even know existed. It completely expanded my perspective and gave me new ideas that eventually changed my entire financial plan. It's difficult to attend networking events as a busy professional, but I try to make time for them at least once or twice a month. The conversations and connections are worth the effort. I meet with bankers who are talking about financing, developers talking about hurdles with city officials, and wealth managers talking about their latest investment strategies. Building these relationships has proven to be critical in my journey because ultimately people like to do business with people they know. Now, relationships are great, but don't let them sway you too much. You have to do your own research. For example, early on I invested in a deal because a friend recommended it. I barely skimmed the legal documents, just trusted their judgment and wired the money. Big mistake. A year later, I found out the deal had a very different payout structure than I expected, and I had no one to blame but myself. That was the day I promised myself never again. Now I read every document carefully, ask every question I can think of, and even bring in legal or financial counsel when needed. Taking responsibility for my decisions has made me a smarter investor. I know a lot of us working full-time find it difficult to read these long legal documents, but it's essential we understand the key features. Once you review them a few times with a legal expert, you will know what things to look for. For instance, if you're considering investing in a real estate syndication, make sure you understand how the profits will be calculated calculated and shared, and how capital calls work, how much the operator is charging in fees, etc. If you want to learn more about real estate syndications, make sure to download my free ebook below. I'll link it in the description. We hear about these great returns, but it's important to remember that the returns cited are average returns over several years. Warren Buffett famously said, "The stock market is a device for transferring money from the impatient to the patient." His company, Berkshire Hathaway, has achieved returns averaging nearly 20% from 1968 to 2023. But some years, he only made 2%. You can't hit a home run every year, but if you're patient, the opportunity will arise. And this one was tough for me because I remember being eager to invest in the next exciting stock or real estate deal, but I learned that that leads to poor decisions. The key is to be patient and wait for the right opportunity. Take your time and do your research. Then, once you've made the investment, be patient for your returns. And remember, even good stocks fluctuate in value. Growth is not linear. Just look at this graph of the S&P 500 over the last 10 years. If we zoom in, we can see that it was quite a roller coaster, but overall returns were steadily increasing. You can see how if you buy and sell at the wrong times, you would lose that growth. You can only avail the long-term growth with patience and consistency. One investment likely won't build significant wealth. It takes consistent investments over time. I know it's difficult to remember investing when we have so many other things to do, so it's best to automate your savings and investing. Wealth habits are a lot like health habits. Consistency gets results. Instead of trying to figure out how much and where to invest every month, use a method like dollar cost averaging. Dollar cost averaging is a strategy of investing a fixed amount of money at regular intervals, regardless of market conditions. So instead of investing $12,000 all at once, for example, you would invest $1,000 per month over 12 months. By investing like this, you take advantage of price fluctuations. You buy more shares when prices are low and buy fewer shares when prices are high. And this lowers your average cost per share over time. To do this, choose an investment account like a retirement account, 401k, IRA, or a taxable brokerage account, and pick which ETFs or stocks you want to buy, like VTI or SPY, and then set up automatic deposits monthly or bi-weekly from your bank. Here's a sample table of how dollar cost averaging works. As you can see, for a total of $4,000 invested, 525 shares were bought, and the average cost per share was $7.62, even though the stock price ranged from $5 to $10. So volatility isn't so bad after all. Take advantage of the downside. Within a few years, you can build substantial savings. So which of these 6 stories resonates with you most? Where do you think you could grow as an investor? Drop a comment below and let me know. I'd love to hear your journey. And if you found this helpful, make sure to like and subscribe and share this video with a friend who's trying to figure out the right investment. Because remember, it's not about finding the better investment, it's about becoming a better investor.